for all that talk of pessimism, investors never really abandoned stocks last year. Yeah, allocations came down, but they didn't get below average. And now, over the past couple months, they've expanded. Happy Thursday. Welcome to Townhall Takeaways. Willie Delwich here. Glad you're tuning in. The Townhall Takeaways is a chance to step back from some of the noise of the day-to-day environment and really focus on a few key themes for the week, for the market, for the economy, for the Fed. Kind of distill all the noise down to a couple nuggets to really pay attention to, really take home with us at the end of the day or at the end of the week. Lots of things we could pick in this pivotal pivotal week for the markets. We have the S&P 500 breaking above its December highs. Looks like it's finally getting that higher high that we've been looking for. Pivotal week from a data perspective. We saw a surge in job openings, calling into question some of the views about whether or not the Fed has its pulse on the correct data to look at inflation. Pivotal data for week for the Fed. The Fed raised rates yesterday, talked about having to probably raise rates again. And what happened? Bonds rallied, stocks rallied. Basically, the market called the Fed's bluff and said, "We don't believe that you will." Lots of tension there. Lots of kind of haven't seen this before kind of moments in the market. So with all that as a backdrop, I think kind of zooming out, letting some of the noise dissipate, focusing on a few key themes, I think would be helpful right now. So the first theme, the first takeaway from this week is while we've seen way more new highs, in January than we saw in January of last year. In fact, saw more new highs in January, more new highs versus new lows in January this year than we saw all of last year, as many as we had last year. It's a reversion to a normal type of environment. So the 20 days with more new highs than new lows that we had in January was also the same number that we had all of it last year, but that's just par for the course. We're actually just in line. 2023 is in line with the median going back 20 plus years. So yes, we're seeing more new highs and new lows. And yes, it's a dramatic change from last year, but this isn't the aberration. Last year was the aberration in terms of the persistent weakness that we saw. Doesn't mean that we'll continue to rack up more new highs and new lows like we've done so far in January. Doesn't mean that we won't, but just putting it into perspective, last year with its broad weakness, high levels of volatility, that was the historically unnormal year. What we're seeing so far this year is pretty much par for the course in terms of days with more new highs and new lows. So it's helpful to think about that, because then we can keep track of, as we go through this year, as long as continuing to see more new highs and new lows, so that we know whether or not we're still in harmony with an environment where stocks would tend to rally or stocks would tend to weaken. As long as we've got more stocks making new highs and new lows, that's an environment that typically sees strength. So we can lean into that. So the first takeaway, last year was aberration. This year is something of a return to normal when we look at the new highs and new lows data. Some more perspective to think about, zooming out, not getting caught up just on where we are relative to where we were in January or October lows or anything of that. Let's look at what the longer term trends are. And we can look at it from the perspective of the value line geometric index. And we're bumping up towards 600, bumping up towards where we were in August. But we zoom out and that's not much different than where we were in late 2017, early 2018. And so you put the last 5+ years in perspective, lots of volatility. Value line geometric index went from 600 down to 300, up to 700, down to 500. Now it's back up to 600. Lots of volatility, not a lot of sustained strength there. So when we think about median stocks and the median stock or the performance of the median stock, lots of sideways action over the past few years. Think about that from a trend perspective for the S&P 500. 43 weeks now of a downtrend for the S&P 500. So well off our lows in some of the areas that were particularly weak last year. But when we zoom out, the trend for the S&P 500 remains lower. The 200-day average for the S&P 500 continues to fall. So slowing things down, not getting caught up in the day-to-day, week-by-week volatility, I think that's where patience really pays for investors, and having the bigger term perspective in mind can be helpful. And then from a sentiment perspective, saw data this week, not from AAII, but from Investors Intelligence and from NAIM, showing investors continue to embrace the strength. And we want that. We want to see more bulls if we're going to have a bull market. But from a longer term perspective, I think it pays to focus not just on that weekly sentiment, but the positioning data. And so we got the AAII asset allocation survey. That's a monthly data through January, shows that for all the talk about persistent pessimism, and we've seen 44 weeks in a row now of more bears than bulls on the weekly AAII survey, for all that talk of pessimism, investors never really abandoned stocks last year. Allocations came down, but they didn't get below average. And now, over the past couple months, they've expanded. So up to 65% exposure to stocks versus an average of 62%. It's bonds and cash that investors are not embracing. They didn't embrace bonds. They haven't embraced bonds at all. They moved briefly into cash last year and starting to retreat. From a long-term perspective, the odds for sustained strength and big gains in the market are much higher when investors are in cash and have reduced equity exposure. The chances for sustained strength and big gains are much lower when investors are fully invested in stocks, which is what they are, if not fully invested, at least above average exposed to stocks right now. So while we talk about pessimism from last year, just remember, investors never really gave up on stocks. There's still that laissez-faire that is intact. That's good for now, but probably dampens the prospect of sustained strength going forward. That's one of the focuses on positioning. The other thing with positioning is talking about last year being an aberration. Last year was from a strength and weakness or weak strength perspective. Last year was also an aberration from a positioning versus sentiment perspective. Investors got really pessimistic. They didn't do much about it. And so as we go into this year, one of the big questions is, how does the historically normal relationship resume? Do we see high levels of exposure and increased optimism, which is so far what we're seeing? Or do we see continued pessimism bringing exposure down? That is not what we've seen at this point, but we also have not resolved kind of that disconnect between positioning and sentiment. So there's more work to be done in that regard. Relationship between equity exposure in the AAII survey and the Michigan Consumer Sentiment Index still looks a lot like 2023, 2022, not like the historically normal relationship. So those are the takeaways. One, last year was the aberration. This year's strength is what we tend to see in the market. So let's pay attention to that we continue to see that. Trends have not broken out from a longer term perspective. There's work to be done there yet. And investors remain fully invested in stocks. They never really gave up on that embrace of equities last year. They remain fully committed there. They haven't made some sort of great rotation from into bonds and also haven't built up huge positions of cash on the sidelines. Thanks for listening. Thanks for tuning in. This Townhall Takeaways, do it every Thursday afternoon. Thanks for joining, and I hope to talk to you again next week.